Welcome back to Kitco Mining's Digging Deep with me, Paul Harris, in which we take a closer look at some of the most interesting news items in the mining space. Joining me today is Joe Mazumdar, editor of Exploration Insights. Joe, welcome back to Kitco.
Hi, Paul. Thanks for the invite.
Joe, it's not raining, it's pouring, with two new gold mines making their first gold pours. IAMGOLD poured first gold from Côté in Ontario in Canada. Congratulations there. Côté is due to ultimately produce 365,000 ounces a year life of mine, $2.965 billion capital cost there. Also, Goldfield started production at its Salares Norte mine in Chile. Its first gold silver doré poured there. For the first 5 years, the mine is expected to produce 485,000 ounces per year and 360,000 ounces per year life of mine. Capital cost there about $1.2 billion. Their timing couldn't be better, with gold hitting a record $2,300 per ounce this week, but both are late and over budget. Joe, why are we seeing so many cost and schedule overruns in new builds?
Well, some of the cost overruns are definitely due to the underlying inflation. And so we've had, especially in Canada, labor costs, fuel prices are going up, energy costs. Some of these projects have been, hit by scope changes as well. And the capital cost increases are also reflected not only in the gold sector, but we've seen it in the copper sector with Quebrada Blanca 2, with tax cost blowouts there. So it's not just the gold industry, anybody building projects, even though there's not a lot of projects being built. It's not like, back when, you could buy a truck and not get any tires. We don't have that, but we still have constraints on supply chains, enough so that that's also hitting a lot of companies with respect to costs.
Now, those inflationary pressures are still there, although moderating somewhat. So is that a disincentive for companies to initiate new builds at the current time?
Well, with respect to gold, probably not so, as the gold price right now seems to be going up at a higher rate potentially than their costs. But, just recently, probably in 2023, it was the opposite. The costs were going up at a higher rate than the gold price. Now with gold price projections to, potentially go up to 2,400 plus before the end of the year, there may be incentives not only to build projects, but more importantly for M&A, and which is what we're seeing right now, is companies are seeing that the price is going to go up and it's best to get projects now. And potentially the sweet spot are those development projects that are probably being hit twice by not only negative sentiment that existed in the gold sector in 2023 and probably most of the first quarter of 2024, and also the fact that retail and most investors don't like development projects because of the same cost capex blowouts that we just discussed.
Okay, now the gold price is up more than 10% to the start of the year. Record levels this week of almost around $2,300 per ounce. And as you mentioned, Joe, forecast to go much higher this year. Mergers and acquisitions activity is starting to accelerate as well. And it seems there is evidence that the window is opening for financing for junior explorers. Yukon Canada explorer Snowline Gold did a $25 million or announced a 25 million Canadian bought deal this week, which will increase its cash position to more than $70 million. And Meridian Mining also announced a 15 million Canadian bought deal. Bought deals are certainly a sign that confidence is coming back.
Yeah, as long as those bought deals are covered and they're not hanging, they could be risky. But in this environment, what we should be seeing with the gold price going up is a more of a flood of financings, because the season is coming, and usually those financings happen in January to March with the anticipation of the field season and the Northern Hemisphere in June, July sort of time range. That's been delayed because there hasn't been that much demand for that equity. If everything goes well, those gold companies should be seeking, to do financing transactions, and there should be some demand there. So that would be another sign that the market's turning, the recapitalization of the industry. I think we're there, or we're getting there, and we've seen positive signs on the M&A sector. Now we need to see it on the financing sector. And the better the financings where we see less warrants, more at the money or bought deals, that sort of thing, then that's a big positive. But we might see that with the better companies first, like your Snowlines, which has a potentially great asset there at Valley, and then coming down to the others.
I like your use of the word flood there, Joe, because if we go back 3 or 4 years, there was a flood of equity investments into the junior space. And as a result of that, there were some very, very big, a lot of companies did very, very big drilling programs. That's obviously sort of really come off, and a lot of companies are now, their treasuries are bare. But we haven't really seen that flood come back despite precious metals, really starting to move. Why do you think there's that delay, that pause?
Well, I think right now, I mean, when people are anticipating the gold price going up, they're buying physical gold, buying gold equity ETFs, and then that's going down to actually individual companies, from the big guys to the small guys. The problem is a lot of the people that have potentially made a lot of money in the equity markets, the broad equity markets, institutional equity funds and that are looking at an undercapitalized sector like the resource sector to invest in. When they talk about microcap, they're talking more about $1 billion market cap company. So for them, the liquidity is an issue in terms of investing in the entire sector, because it's been beaten up so much. The valuations are very low. I mean, that's an opportunity, but for them, they see it probably as a risk with respect to liquidity. So we need the retail sector, high net worth individuals, family offices, stuff I've seen at the Swiss Mining Institute recently, those sort of people to come down and fund these smaller plays.
Now, investors really are still open to the positive power of drilling results. And we had a good example of that just last week when Awali hit 32 meters at 45.7 grams per ton gold at its Odien project in Côte d'Ivoire. The story jumped more than 100%. The share price has increased from 18 cents to more than $1 since March the 18th. A very good hole there, Joe.
Yes, I mean, that entire land package is very prospective. I owned it several years ago. At that time, the private placement was 6 cents. It did an 8-to-1 rollback, so conceptually, my entry level would have been more like 48 cents. I sold it because it was having problems with funding. There was some management issues, and they were just weren't getting the results in this prospect I was bullish on, which was Empire. The new prospect that they just drilled, which was there before but they hadn't been able to drill, was Charger. And so these are these little vertical breccias that are going through this intrusions, and where they're hitting some high grade. What's interesting about it as well is that, usually in that part of Africa, they do a lot of air core drilling to find out what the geochemistry is below the cover. And then after that, they do some scissor holes to figure out the orientation. Those scissor holes that if you look at the cross section, didn't really hit much. And despite that, they drilled this deeper hole, which gave you the intersection that you just quoted. So that's, for me, very bullish for the company, for that style of mineralization, and for the management team to take that step and that risk to drill that hole.
Okay, while we're on the subject of junior explorers, I've got a sort of couple of other things to discuss with you. Save Canadian Mining has been railing against naked short selling for a number of years now, and this past week they announced their intent to start a $1 billion Canadian class action lawsuit. They need 10 companies to get behind this to begin the class action. They say naked short selling has allegedly cost Canadian junior mining companies more than $40 billion, basically by beating down their share prices. Joe, what's your view on this naked short selling argument?
Well, one, I hope some of these junior companies don't anticipate a class action lawsuit against them for some overspending that they do. The thing about naked shorts is that they're very risky for the person that's taking that position, because unlike when you buy a share and you ride it up, I mean, you can make a lot of money on it. But if you take the naked short position, you're betting that price is coming down. And if it keeps going up, you got to buy it back. So your loss as well could be infinite. And it's, for me, that's a very high risk for an individual to take, as well as the liquidity risk in a junior company to actually try to buy back that position so you can get out of your short, because you don't have one. You don't have a position, hence the naked part. So I think, like, for most people, for anybody, like, a naked short position is a very risky thing to do, especially in an illiquid stock or an liquid sector. Yeah.
And you have that exposure for potentially quite a long period of time as well, don't you?
Yeah, until you borrow those shares from somebody, and then they're willing to lend it to you at a fee for a certain amount of time. But if the stock goes up, you have to buy it back, and if it's not very liquid, it'll take longer to buy back, and then your buying back will drive it up even more, and your losses will be quite big. So if they are short positions out there, this reanimation of the sector, especially the gold sector and the overall resource sector, will make these guys act, and those kind of companies will have more of a bump when it turns around. Again, I think from one side, a naked short is a very risky sort of investment strategy for an individual, especially a liquid sector. On the other side, the best thing for those companies to do is have catalysts, positive catalysts, run the company well, and push those shorts out and squeeze them. I think that's the best action to do. You have catalysts, do the right thing, and then those guys will leave, and then they'll give you a little bit of a bump in your stock.
Every month we see a non-cash flowing junior explorer initiate a normal course issuer bid to buy back their shares. Is this part of a strategy, you think, to perhaps combat naked short sellers by creating some buying pressure, some buying action for their stock? Or is it perhaps more a case that the companies run out of ideas? Because, cash is king. It's still a very difficult market in which to raise equity. So companies, voluntarily giving out cash or spending their cash on something that isn't exploration and a catalyst, as you say, would seem to be ill-advised.
Yes, I mean, as you said, the last few years, working capital, especially for non-cash flowing junior companies, is what people look at. So when somebody sees you have, let's say, $5 million, and then you've allocated maybe 30%, 40% of that potentially to a normal course issuer bid, then they're wondering, okay, now that runway that I have for you in terms of when you need to come back to the markets, you might have to come back to the market quicker. So somebody might not buy you because now they're thinking that you're just going to spend that money buying your shares back. So I agree with you that it's probably ill-advised. Unless you have some kind of steady revenue coming in that says, okay, I think my stock's undervalued, which a lot of people do. I mean, in a sense, if you're a shareholder, that's a positive because they're supporting the stock, but then they don't have cash to generate catalysts, which are really what moves the stock. It's not supporting the stock that, moves it. It's really generating catalysts in those drill holes, like you talked about with a Wally that, doubled their share price in a few days. So for normal course issuer bids, with somebody that's not cash flowing, yes, that's also a very risky thing to do.
And obviously you invest in a junior explorer for exposure to exploration success, not to, spend money working on the share count. While we're on the subject of, let's say, improper methods, a very interesting news release this week from Northwest Copper, who announced its chair and director, Grant Swayak, resigned. And Grant gave his reasons for resigning, which include, and I quote, certain members of NWST's retail shareholder base have approached board members and used highly improper methods to try to cause decisions to be made which would confer upon them a personal financial benefit. In my case, I've been threatened with personal litigation on more than one occasion for resisting such approaches. Wow, Joe, what do you think of that?
Yeah, well, the thing is that, with these junior companies, some high net worth retail, some individuals when they have such a large position, believe that they own the company and the board and its strategy and everything. And so they have a big pull within the company and potentially some of those board members. I don't know the individual, but he might have come in thinking that, okay, here's a company I can run. Here's a strategy that we've agreed on that I'm going to implement. And when he starts implementing that strategy, somebody from a large shareholder says, well, no, hang on a second. That's going to cost us too much money. That's not going to generate the catalysts I want, and that's not going to get the share price to go up in the near term. So I'd rather you did this. And that guy might have said, well, no, that's not what I want to do because we need to understand this, this, and this. And so he might have been a bit, put off by that entire scene. And good for him to say, you know what, I don't need this. I'm just gonna leave because this is not what I signed up for. There's very few individuals in the sector that do that. So kudos to him.
Yeah, that was the thing that stood out for me. I imagine this happens at quite a lot of companies, but very few take the step of actually vocalizing that, hey, this is happening, this is an issue, this isn't right.
Yeah, you could get that on the broker's side as well. I mean, when you got a target price on a company and then there's somebody in your firm that owns a lot of shares and says, oh, hey, your target price looks a little low, implying that you got to do some work and get it up there, because all these other people's have a higher share price, target price than you. So yeah, some of this could be, direct, and some of it could be indirect, suggestive, but it all happens. It definitely all happens. And this is not in an individual case, an anomaly in the sector. I guarantee that.
Okay, let's change track. Critical minerals, the critical minerals bandwagon specifically. I saw a report this week by Hall Garden, based out of London, who complained about the number of minerals companies that are claiming that want their particular mineral of choice to be added to critical minerals lists. We're seeing gold, silver, graphite, and boron. Are too many minerals being claimed as critical or critical for the energy transition, et cetera, et cetera?
Well, I mean, sometimes it does look like the entire periodic table is critical. But what's really, I mean, if you look at the USGS and what they've been asked to do for the U.S. government, they're renewing this critical mineral list, and they have this sort of XY graphs that sort of says that, the importance of the element to the carbon neutral technologies that they want to expose themselves to, versus the supply chain risk. And the ones that are at high risk on the supply chain as well as high importance, that's what's deemed critical. And then now they've developed a near-term critical and a medium-term critical, which I think is important. And some of these minerals, elements, progress from not being critical in the near term to becoming critical in the medium term, which I'm not sure how you react to, because the near term becomes medium term pretty quickly. But I mean, so there has been an advocation for, if that's a word, I used it, but for copper, and I really support that one, because I don't think the USGS understands that a lot of the reserves and resources in the US are actually permittable and could be built. And also there's not much processing capacity in the US regarding smelting. So I think the copper is a more of a critical mineral than they had initially put, and that people that have advocated that, and now it's now a medium-term critical mineral. I don't know the demand and supply for everything, but people just advocating for something just to have their mineral put on, stretches a bit, why they're doing it, because they want to gain access to that investing crowd that sees things and calls them critical.
I agree with you on the copper there, Joe, because the largest amount of copper is produced as concentrate, and the bulk of those concentrates are processed in China. So a lot of the refined copper in the world comes through China in one way, shape or form. It does seem that a number of, we've seen this in the silver sector. Silver is very abundant, but because it's used in solar panels, people are claiming it's a critical mineral. It does seem it's either they're doing this either as a marketing, to create some marketing buzz, or potentially they think that if they get that designation, they can potentially access some government funding, whether that's from the European Union or the United States federal government, the Department of Energy, Department of Defense, etc. What do you think is the sort of motivation there to try and get your product deemed critical?
Yeah, the thing is that, I mean, the governments have a lot of issues, but they're not that stupid. Because even with critical minerals, they're not focused on funding mining. They're more focused, at least in the US, on focusing on processing. And it's kind of funny that you say that people are, including everything into critical minerals. So I was down in Australia at a gold conference called the Victoria Gold Conference in Melbourne. And there was a guy there that the title of his talk was Gold as a Critical Mineral. I can tell you that the first slide said that, and then everything else was about every critical mineral besides gold. And all he did was have gold as a critical mineral as a title to make people come and see his talk. That was it. But, the relationship of gold to becoming critical, why should it be critical? Nothing. So, people like to use the word critical just to get more eyes on your company and that. But it's people are just going to get tired of that, just like they get tired of, offtake agreements with Tesla. It's just, once everyone's doing it, nobody cares.
Just becomes noise.
Yeah.
Okay. Well, I think that's it for this week, Joe. Thank you very much for joining us.
All right. Thank you, Paul.
And this is Paul Harris for Kitco Mining, digging deep. And if you like what you see, don't forget to subscribe.